Hi, Matt. It's been a volatile start to August, with markets reacting to weaker than expected economic data, in particular the recent jobs report, and to President Trump's latest tariff proposals. So can you share how you're thinking about these latest signals?
So markets have been pretty complacent, for want of a better word. They've been pricing a Goldilocks scenario where they're expecting double-digit earnings growth in 2026, and at the same time, soft enough but not weak labor markets to justify interest rate cuts. And so for equity investors, they've been looking forward to this perfect combination of earnings growth and lower interest rates. And the problem with that scenario is that Goldilocks states of the world rarely tend to persist. We have, as we've discussed in the past, very accommodative fiscal settings. If that goes unchecked, we end up with a more inflationary dynamic. The job market gets tighter, chasing that higher profit growth, and that could be inflationary in nature. On the other hand, as you referenced the tariffs, if we raise tariffs much more than the market was expecting, the combination of uncertainty and higher costs is going to produce slower growth. And I think what spooked the markets lately is that the actually announced tariffs have been higher than expected. The degree of fiscal tightening is therefore higher than expected. And we're seeing some softer job data. And I think that's spooking the markets, that we may be at a cusp point where we leave the Goldilocks scenario.
And now with the September Fed meeting shaping up to be a key moment, and a lot that can happen between now and then, are you doing anything to shift positioning? And are you seeing any opportunities starting to emerge?
Well, it's very difficult for us to zig and zag ahead of anticipated Fed policy shifts. It's not really the way we invest. We're incredibly long-term investors. But I think you can imagine that in the state of the world where there's been some softness in parts of the economy, that we've seen some opportunities there. Healthcare, for example, in the United States, where sentiment's been extremely negative despite equity markets being buoyant overall. Secondly, to the extent that we've had concerns about fiscal issues, not just in the United States, but globally, we've seen value in some of the lower beta substitutes to sovereign debt, such as consumer staples, where they offer attractive free cash flow yields. And in certain parts of the world, Mexico, for example, we've seen some opportunities pop up. And so I'd say that it's highly idiosyncratic, but we tend to go where the market enthusiasm is not. And so that's how we're sort of taking advantage of this moment leading up to the Fed's action. And we tend to be able to take advantage of market movements after the fact, either as a seller or a buyer. So we'll see what the Fed does, and we'll see how the market reacts, and we'll see what opportunity set gets presented at that point, rather than trying to predict it.
Thanks, Matt.
Thank you.